Well, welcome to the last chapter. You've made it to chapter 14, and I'm sure you're glad that the semester is getting close to the end. Hopefully, you've learned a lot, certainly a lot about managerial accounting. So, the last chapter we're going to cover is really capital budgeting decisions. And of course, a capital budgeting decision would deal with assets that are older or have a life greater than a year. And it would be, replacing things, it would be buying other companies, it would be buying a division, creating a new division, etc. Plan expansion, equipment selection, lease or buy, equipment replacement, cost reduction. So these are capital budget decisions. Capital budget tends to fall into screening decisions. Does a proposed project meet some preset standard acceptance? And preference decisions, selecting from amongst several competing courses of actions. And so there are various ways to evaluate a project. And so this is really has to do with analyzing cash flow. When a company buys another company, what they're really looking at is cash flow. How much are we going to have to put out for this company? And then how much are we going to save? It's sort of like last chapter where we're talking about incremental. And that's really what we're looking at, but we're looking mainly at incremental cash flows that would involve looking at the tax situation because we're looking at the after tax cash flow most likely. And we're looking at, either a payback method, a net present value, or internal rate of return. And so the net present value and the internal rate of return takes into account the um, time value of money. The simple rate of return method focuses on incremental net operating income. Typical cash outflows, repairs and maintenance, incremental operating cost, your initial investment, working capital. Inflows or salvage value. So when you sell the equipment, incremental revenues. So you bought a new piece of equipment, you're able to manufacture different products. You're making a product now that you didn't. Reduction in cost. So you get a new machine. Just like the new air conditioner, you have a reduction in cost because it uses less electricity. And release of working capital when you sell the product. So again, the time value of money just means $1 a day is worth more than $1 a year from now. And we, of course, know this from a couple of years ago when inflation got to be about 9%. And you realize that now things just cost more. And so $1 2 years ago was worth more than $1 today. Look at discounted cash flows. But that's the important part is we're going to look at the cash flow. And some of the reasons some of these mergers don't work is just basically whoever put their assumptions were wrong. So they might have, a lot of these companies, they think that they know what's going on and they buy these companies of these people who started them and, it's their life to them. To the buying company, it's just another company. And so they think they know more and they find out, maybe they lose customers because they don't have the same connection with them, or they don't really understand the business as well. But we're going to look at discounted cash flows. And when you buy a company, that's what you do. You come up with a pro forma and say, based on this price, this is what would happen. Calculate the payback period of an investment. So we're looking at the length of time. So I'm going to make an investment. How quickly will I get my money back? It doesn't take into consideration the time value of money. So it's just basically a fairly simple, what is my investment required? What's the annual net cash inflow? And so how many years does it take for me to get to that point where I have got my investment? So Daily Grind wants to install an espresso bar in its restaurant. Costs her $140,000, has a 10-year life. It'll generate annual net cash inflows of $35,000. So that's revenue less the expenses. Management requires a payback period of 5 years. So really, we're looking at 5 times 35,000. So that's 175,000. So this would satisfy their requirement of a 5-year payback. Consider the two investments. So $100,000 in each one of these, and in cash we get $100,000, but Project X we get 100,000 back in 2 years versus Project Y, which we get 100,000 back in 3 years. Obviously, year two, Project X has a shorter payback because we get the 100,000 back in 2 years. Unfortunately, this ignores the time value of money, and money does. There is a time value of money. It ignores cash flow after the payback period. So all they're concerned with is how quickly do we get our money back, not what's the whole cash flow for the whole time of this investment. Because a shorter payback period does not always mean a more desirable investment. Because one may have a shorter payback period, but also a shorter period where it's going to continue to produce cash. It is a screening tool. You can quickly go, hey, we don't want, we want to first look at things where we get our money back in 5 years, and then after that, we may evaluate them on a different basis. So again, it shows how investments that would be recouped quickly, identifies products that recoup initial investment quickly. When the cash flows change from year to year, the payback formula introduced earlier cannot be used. So here it's very random. So this would be um, distorted. So we're going to use a net present value, which means basically we are going to look at cash outflow and then the cash inflows, and we're going to plug them into a formula, Excel spreadsheet, whatever, and we're going to discount that at our rate of return. So we want to say, well, hey, what is the net present value of this investment if we want a return of 10%? So all cash flows other than the initial investment occur at the end of the period. All cash flows generated by investment are immediately reinvested at a rate of return equal to the discount rate. So if we assume we're getting a 10% return, then we're assuming that once we get that cash, that positive cash flow, we take that cash and we invest it in something that also returns 10%. So here's an example. Cost is 160,000. We would need to tie up $100,000 of working capital, so that's 260,000. Relining equipment in 3 years, 30,000. Salvage value equipment in 5 years is 5,000. Annual cash revenue and cost, sales revenue from parts is 750. Cost of parts is 400. Salaries are 270. So that is 670,000. So that leaves an $80,000 net cash flow after year one. And so we want an 11% return. So if we discounted that cash at 11%, what would the net present value be? So again, we have annual cash flows of $80,000, and we would need to front 160,000 for the equipment, $100,000 for working capital. Working capital was, accounts receivable. So most likely we would uh, have business coming in, but we would have terms of 30 days. So we wouldn't really receive any money for 30 days. And so that would be tied up in the business. And as the business improved, more and more would be tied up in working capital. So the present value of an annuity of one factor for 5 years. Now there are present value tables, but you can get an HP 12C, I believe. I think they still make them. I've had mine for probably 40 something years, and you can just plug it in. It'll give you the amount. It's a lot easier if you have a consistent number each time. Otherwise, you can use Excel. Alternatively, the individual annual net cash flows could be discounted using the related five separate present value of a single payment of one factors. So basically, the present value of one factor, present value of one of the release of the working capital and the salvage value of the equipment is 62,000. Um, so the net present value, this assumes that after 5 years, we sell the equipment, we get our working capital back. And so in year five, not only would we get $80,000, we would also get 105,000. So the cash flow in year five is going to be 80 plus five plus 185,000. And so the present value of one here is going to show you, I mean, this is one because we put it out in year one. This is the factor for an annuity. This is a factor for 3 years down the road. What $30,000 3 years down the road would be worth 21,930 today. So we have a positive net present value of $76,000. So we would take the project. Here's another one. So we're costing us 250. We have to invest 20,000 in working capital. We have to upgrade the machine in 2 years. Salvage value in 4 years is 10,000. Annual net cash inflow of 120,000. So this project's going to go for 4 years, and we want a 14% return. But it's a net present value of the contract with the local bank. Um, Here are the factors. I don't know. Anyway, again, there's two different factors. The factor of a single payment, which would be the equipment, the investment in the equipment, the working capital, and since we pay that now, that net present value would be the current value. And then a factor of an annuity. So this would be an annuity of 11% over 4 years, and that factor would be 2.914. In 2 years, we would have to upgrade the equipment, which is worth 69,000 in today's dollars. And then we have the salvage value, the working capital, and that would be worth about 16, 17 plus in today's dollars. So at 14% return, you would really, basically what this says is you get a higher return than 14%. And Lester companies can offer a 5-year contract to provide component parts for large manufacturer. And let's just go with, they have discounting at 11%. Since the investments in equipment occur immediately, obviously we're going to look at that. And then here we're going to look, we have different cash flows. So we don't have a series. So in the other ones, we could look at an annuity of whatever, however many years at 11%, what that factor is. Here we have to go to the tables and go, okay, 1 year from now, 11%, what is cash worth? 2 years from now, 11%, what is cash worth, etc. And so we're going to add up all these numbers. And the net present value is 76,000, which again means that we would get a positive return at 11%, but in actuality, our return would be higher than 11%. Positive net present value indicates that the project's return exceeds the discount rate. A negative means we're getting a poor return. So the net present value is positive, acceptable because it promises a return greater than required return. Zero, acceptable because it is giving you the rate that you require. Negative means it's giving you a rate less than what you require, so you should not accept it. Now, how do you determine the discount rate? And that's really the cost of capital. And the cost of capital is dependent upon the equity and the debt that you have as a company, and then the what your shareholders expect a return on your equity, and then what your aggregate average uh, rate of your debt is. So it's an average return the company must pay to its long-term creditors and shareholders. And it's a very complicated number. Usually the CFO is going to give you that number. The net present value method automatically provides for return of the original investment. All right, we're going to buy an X-ray machine for 3170, has a life of 4 years, no salvage value. We're going to increase annual cash flows by 1,000. No investments are to be made unless they have an annual return of at least 10%. So will we allow the investment? And again, this is an Excel spreadsheet, recovery investment during the years. Okay, so we're going to put out 3170, we're going to get 1,000. And so the present value of the investment is zero, which just means that, yeah, it fits your criteria. So this implies that the cash flows are sufficient to recover the original investment and provide a return of 10% on that investment. Now, internal rate of return is the rate of return promised by an investment over its useful life. So it's very similar to the net present value, but it would, yes, return a net present value of zero. So really what you're going to do is you're going to do a calculation. You're going to put in all of the cash flows, and you need a computer really to do this. I mean, you can do it, but it's really time consuming. Even my HP 12C, which is a financial calculator, whenever I do something like this, and so I may say, well, if I want $100,000, um, or if I'm going to get $100,000 in 10 years, and I'm investing X amount every month, what is my return going to be? And then it will calculate it, but it does all these iterations. And so even my 12C takes some time to calculate. It works very well if the cash flows are identical. If the cash flows are not, then it's really a trial and error. And even on my 12C is difficult. So if the internal rate of return is equal to or greater than your cost of capital, you accept it. So the cost of capital is the hurdle rate. Here, Decker can purchase new machine at 104,320 that will save $20,000 per year in cash. So that is basically what their cash flow is. You spend 104,320 in year one, and then you are going to discount 10 years of $20,000 payments and then determine what that rate of return is. So the present value for internal rate of return is the investment required and the annual net cash flows. And so find the 10 period row, move across until we find 5.216. All right, so we have 104,320 divided by our annual cash flow gives us 5.26. And then we go to the tables and we're looking at 10 years at 5.26, and that means it's a 14% return. So if our rate of return, if our cost of capital is less than 14%, we would do the project. Expected annual net cash inflow from a project is 22,000 over the next 5 years. Required investment now is the project is 79,310. This is something great for an HP 12C. So I'm going to put in 10 in. My investment would be a negative 79,310. So that would be my present value. My payments would be $22,000. No future value. So what is my return? And so now it's calculating, 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 calculating. So it's having to do all these iterations, calculating, 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 still running, still trying to figure this out. And it says 24,680. Let's see if that's correct. 12%. I must have over the next 5 years. Okay. I thought it said 10 years. Okay. That was the problem. So I'll put in 5 and see what I have. That's 5 for N. And what is my rate of return? So this is not an easy calculation, and really you need a computer to do this. It's can be very complex, but you can use present value, and I get 12%. So I should have gotten that the first time if I had paid attention. One thing in counting I always say is RTDQ, read the damn question. Net present value is often simple to use. Internal rate of return method assumes cash flows are reinvested at internal rate of return. So if you get a high rate, is that realistic? If the internal, again, it may be unrealistic. You're assuming that cash flows will be reinvested at the discount rate, and that's not always the case. So I have two alternatives. White company has two alternatives: remodel an old car wash or remove the old car wash and install a new one. So the annual revenues, the annual operating expenses, this is the cash flow, and then the cost of this is 300,000, productive life 10 years, salvage value 7,000. Replace brushes at 50,000, so we're going to discount that over 6 years. Salvage of equipment, we're going to discount that over 10 years. And so install the new washer, we get a net present value of 83,202. And if we just remodel the old washer, we get a net present value of 56,405. Doing the same thing, looking at the cash flows. Here, you'll probably have to, again, you've got to remodel versus redo. And so the other one, you had a return of 83,202, but your outlay of cash initially was going to be 300,000, and you replaced 50,000 in brushes. Here, your remodel costs are 775,000. Your replacement of brushes is going to be 80,000. So the difference is, according to this, you should install the new washer. So they both yield a net present value, but the install new washer is 26,797 better. So we have decisions where revenue is not involved, then we're looking really at the cost. So this is of an old delivery truck. We overhaul it now for 4,500, or we buy a new one. So our cash outlay would be 4,500, and then 10,000 every year. In 5 years, we can get 250, or we could sell it for 9,000. And so this would be part of the new truck decision. So if we purchase this for 21, annual operating expenses are 6, salvage value is 3. But we really should factor in the fact that we're going to get $9,000 to buy the new truck. But even that, it's still not a good deal. Oh, I'm sorry. It's a better deal. So we're going to have a net cash drain anyway. So we want the lowest net cash drain. So the lowest present value is 32,883 versus a loss of 42,225. So in this case, buy the new truck. If you have uncertain cash flows, assume that all the cash flows related to an investment have been estimated except for salvage value. We're going to use 12%. And so we're going to use the equation can be used to determine the salvage value is at least $10 million. BIOC is considering drafting 4 years, provide cash saving of 10,000. All right, so um, we invest 100,000. We save $10,000, and so net present value is 70,860. So how large would the intangible benefits have to be per year to justify investing in the machine if the discount rate is 14%? And so 70,000 divided by that 14% factor is 24,316. And then you can rank them based on risk, okay? The higher the rate of return, the more desirable the project. But you also have to factor in risk. The net present value of one project cannot be directly compared to the net present value of another unless the investments are equal. In other words, they have equal risk. And then we have the simple rate of return does not focus on cash flows, it focuses on accounting net operating income. But most companies, they're going to look at um, cash flows. So management wants to install an espresso bar. Cost is 140,000. Will generate incremental revenues of 100,000 and incremental expenses of 65,000, including depreciation. What is the simple rate of return on the investment? 35,000 divided by 140. So we're going to generate 35,000 divided by 140. But this doesn't take into account the time value of money. And the same project may appear desirable in some years and undesirable in others. When investment center managers are evaluating using return on investment, it's much better. A post audit is just a review. Okay, here were our assumptions. Are our assumptions correct? All right. So this winds up the course pretty much from the chapter standpoint. You may be involved in something like this if you're ever going to propose a capital project. If you're, working in industry and you want to save or replace things. I'm not sure how many companies really do it to this detail. It may just be simple. If you're replacing something, what are the costs and what are the savings that we're going to be involved in. But if you're going to make large investments, then your company is either going to use a net present value or internal rate of return. Hope you've enjoyed the class. Hope you've learned something, and I wish you all luck in your academic and professional career.